Market update July 3rd, 2020, going into a holiday weekend. I hope everybody has some nice and safe plans for this nice 4th of July coronavirus quarantine year. Wow. Never seen this, never hope to never see it again, but let's talk about the economic indicators for the week. We're going to talk about unemployment changes, not many Fed changes, but we'll cover the decisions that were made, interest rate changes, housing, inflation, and stock market indexes. Well, here's a virus vaccine update, and if you had attended the webinar that I did a few days ago, I said that I would give you some updates on this. Right now, there are 23 companies in active development. Moderna is, they've got probably the farthest, there's a little debate between Moderna's vaccine and Gilead's vaccine, but that's neither here nor there. I'm trying to give you an update. Right now, the trials are delayed until late July. Moderna stock took a little bit of a hit because of that news. I don't know why, because they weren't anticipated to come out with it until late year, beginning next year anyway. Pfizer, trials continue with successes. So they've actually got a drug out right now that is proven to reduce or eliminate some of the issues with the virus. However, there are some nasty side effects to that with increased fevers, some people extreme nausea, etc. So they're trying to work through that and just determine whether the cure is going to be worthwhile. And then we've got Gilead with a remdesivir, and there's a lot of controversy behind that because the U.S. has bought up all of the 500,000 of the vaccines that were planned to come out towards the third quarter to fourth quarter of this year. There's a lot of kickback on that. The government gave them money to develop some of this, but some of the kickback is that these trials have happened around the world, so why wouldn't the rest of the world get it? Listen, I think with all of what's going on right now, I think that Gilead has licensed somewhere around 50 to 60 different pharmaceutical manufacturers around the world, and they're allowed to produce that. Now, in reading the actual releases of those licenses, it was very interesting to find that any one of those countries within that licensing agreement could call. There's an option in that licensing agreement that allows them to call a emergency and go past their licensing agreement and just manufacture it on their own. So, will the company itself, as the developer of this, be able to make money and still protect their intellectual property worldwide? Probably not, because once they release this, then it will, probably be stolen and duplicated, because the actual technicality of how to make it is going to be released to these people that are licensed to make it. However, for the world's sake, that probably will be the best thing, and for our economy as a whole, that will probably be the best thing. So the targeted date for the vaccine is, again, between April and July of 2021, the next year. Again, I think that as far as my economic mapping, that doesn't really change a lot of what's happening. What did change within my economic mapping was what I did not anticipate, but I said, as long as I'm about 80% on target, then we can all get through this and not just survive, but we could actually thrive through this kind of virus. And those were the protests, and now the non-adherence to safety. Sometimes human nature just absolutely bewilders me. So the California governor admits that the protests accelerated the resurgence of the virus. Well, of course it is. You get tens of thousands of people, 3 inches from each other. Of course it's going to be. Arizona back to 88% occupancy of hospital beds. That's a dangerous place to be. And 5 states now experiencing 50% more in increases. So, California is talking about another total lockdown. Arizona is talking about the same thing. Florida is talking about the same thing. It's basically because there's certain parties that are just not adhering to it. And we now know that the virus has moved from the age 50 as the targeted range down to 33 years old. Why? Well, we got a lot of 18 to 25 year olds. Happens to be the same range of age that the most amount of car accidents happen, which is why they increased the amount of car insurance. And so now we have virus parties unveiled. Maybe you've read about this, where certain kids, 18 to 25 years old, they're holding parties. And they're giving away a pot of money for the first person that they'll invite somebody that has the virus, and then what they'll do is whoever is diagnosed first with the virus gets the cash pot. So they're motivating people to go through this. I don't understand that. I think even while I was a very different person at 25 years old, even at that age, I still don't think I would have understood that. The major cities are reopening. The reopening is delayed due to public transportation. So let's talk about this for a second. We've got places like Los Angeles, New York City, Chicago, Dallas, where a large part of the workforce is trying to get back to work. And in a work environment, sometimes it's very hard to have social distancing. If you have a 6 feet situation, I mean, our firm is a great example. We had, I think, 18 to 20 people in a giant strategy room, and they were all within about now we've been working from home since March, but they were all about 3 feet from each other, which is why none of us have gone back into the office. We're all working virtually. We have a skeleton crew working there just for tax doc drop off, etc. But now you enter something like New York City, where you've got a subway, and these people don't want to get on the subway because, yes, even though you can get to work, and they might be able to have shifts of people coming back and forth to work, you can't avoid being on a crowded subway and be 6 feet apart from people. So now the biggest complaint is people can't get to work again, which is why in my housing report, I'm estimating that we're going to see this mass exodus of people from these dense areas, and we're already starting to see it right now. We're starting to see the decrease in housing values in those condensed areas, and we're seeing the shortage of areas in the suburbs and the Montanas and Wyomings and South Dakotas and Utahs, etc., in the areas where it's not as dense. So let's take a look at the unemployment, because we have some good numbers, but we also have some realistic non-public media that I want to talk about. So last week, 1.48 million workers claimed unemployment, but again, you got to balance that with how many actually came back to work. Again, that's why I say when you watch big media and they claim this for the headlines, you got to look at the numbers that are underneath this. So June 2020, unemployment drops from 14% to 11.1%. However, I want you to always be aware and cautious that the way that the government computes the unemployment has a great inaccuracy behind it. It's all based upon what they call the BLS measuring method. And my estimate is that we're now down to 20% in unemployment versus where we were at 27%. And one of the main reasons is that when they figure out the unemployment, they call workers for interviews and they work on averages. And the workers interviewed are only asked if employed or unemployed. So workers still at home, let's say you're on furlough. Well, you're not getting paid, but you're technically still employed, but you're not working. Well, they're actually counted in the employed rate. So again, if we look at the numbers now, again, where did we learn this from in a big way? Well, I went through that big crash in 2008 to 2010. And I watched exactly what was happening back then when all these people got laid off, and the government was coming back and saying that these are the new unemployment numbers. But we knew that that was not true, because sometimes if you have given up on going back to work, you're not counted in that unemployment factor. If you're home, you're technically employed, but you're furloughed without pay, you're technically considered employed. So again, we got to really watch the numbers. Now, what I'm saying is I wouldn't worry about the 14%. I'm more concerned with where we were in March, April, at the 27 down to the 20%. So added 4.8 million jobs in June. That's a real number, because that's re-employed numbers. And again, I'm expecting that the unemployment rate will, if you use the government numbers and not the alternative BLS numbers, it's going to go from 11% to 6.5% by 2021. Well, not much changed on the Fed side of the Fed decisions. No additional, well, there is one. I was watching, and last week, if you watched, there was a proposal there to extend the deadline of taxes from July 15th to either September 15th or December 15th. Well, the final is IRS is not granting any extensions. So if you've got taxes paid, you better get them paid up before 15th of July. Now, you can file an extension, and the extension will still take you until October 15th, but you still have to make your tax payment by July 15th. Second round of personal stimulus, I still expect that to happen. Second round of PPP, I still expect that to happen. And one of the reasons is that right now, July, it's expected that 658,000 businesses will not be able to stay around unless there's a second round of PPP. Now, there is one big change that happened is there was about 136 billion left in the PPP program. It had gotten down to 100 billion, but there was large corporations that decided that they didn't want to go through the compliance and the public scrutiny of borrowing that money, so they paid the money back. So there was about $136 billion left in the program. Well, that was due to expire if a company didn't make the application, but Congress, and it's on the president's desk over the holiday weekend, but it's fully expected to get signed, that will be extended until August 8th. So if there's a business out there that still qualifies for the PPP, they can still apply for it. Now, what that does for my estimates of the new PPP is I originally thought it was going to be around July 20th. Now my expectations are somewhere around middle of August. What does that really mean? Well, it means that if they open up a second round of the PPP stimulus, that means billions more will come into the economy, right? There's an adverse effect to it in the taxes that we're going to see in about 2 years from now, but it will do wonders for this current economy. Again, they're playing the 1929 crash playbook. Now, the payroll tax exemption, that's still continued to expect to last until the end of the year. Let's look at the economic indicators and interest rates. Well, they haven't changed very much. The Fed rate's still 0% to 0.25. You have average money market rates between 0.15 and 0.25. Average CD rates 1% to 1.25, but here I'm going to make an estimate. Next week, I think we're going to have a big dump in CD and money market rates. I can see us now going back to the 2008-2009 where money market rates might be 0.1%, and the average CD you might get 1% for 5 or 10 years, and maybe 0.5% to 1%. I'm seeing these things line up, especially with what just happened with the Feds and the way that they changed the dividend caps on banks. I think the banks are now trying to figure out, they want their stock price to go up, and they want to be able to produce more of a dividend, because remember, they would rather issue more stock in the capital markets than they would issue bonds. However, if they continue to pay out higher CD rates and money market rates, that reduces their net capital, and the Feds come in and clamp down what they can pay out in dividends. But if they reduce all those, then they can open up a higher dividend rate and still meet their net capital requirements. Mortgage rates down, way down. I'm seeing 2.5 to 2.7 on a non-jumbo 30 years. Never seen that before, even in the turmoil of 10 years ago. Economic indicators on housing, still huge, big problems in California. It's going to get worse because of their non-compliance. So, the governors are in this tough situation. They can't get out of the economic climate until they clamp down on the virus, but people aren't adhering to it and they're fighting back. But some of these governors are being absolutely ridiculous, right? I mean, what was that governor of Michigan? Yes, you could take a boat out. What is it? As long as it doesn't have a motor and it has a sail. I mean, really? Come on. So anyway, the California and nationally, we still have 7.76% of mortgages non-current. That actually number started jumping a little bit last week, and we still have about 8.5 million mortgages in forbearance, meaning that these mortgages are going to come due in March, April of next year, and that's going to be a huge bubble to burst. So the pending sales on homes have gone up, but again, I think that is a false positive. We can't really read this short term as something that we want to invest in housing in these types of housing in the right area right now. Again, but it is much more concentrated to certain areas. Certain areas of the country don't have these problems at all, but it's more of the dense areas. The CFB, what I just talked about, they're removing the debt to income ratio. This could be a danger. This is going back down the same road of 2006, 2007, where people could get mortgages that could not afford them. Again, I'm stating larger cities and most affected virus areas are going to be hit the hardest with the foreclosures and price crashes. I added an additional city onto here that I'm tracking that's had some big problems just in the last week. Originally I had New York, Los Angeles, Las Vegas, and now I'm seeing San Francisco just showed a 30% drop in rental income or rental rates. Used to be the highest in the world. It used to be prior to this, Paris was highest, and then San Francisco beat it. It was something like rental rates were like, I don't remember what it was, but the sale price per square foot was something like average of $1,200 to $1,500 if you wanted to buy something per square foot. So, a 200 square foot house is just, it's unaffordable, right? So this is getting back to the mean of where it should be. Economics on inflation. Well, we see late state openings, non-adherence to social distancing, and we have lower than anticipated return to employment due to the high unemployment. Then we still have civil unrest and protests. Looks like it's died down a little bit in the last week, and hopefully over the weekend we can see a little bit of the maybe the soothing of this over the next maybe 7 to 10 days, assuming nothing else happens, because again, that's a big part of the virus spread. So I have an adjusted estimate of inflationary increase from August of 2020 to December of 2020 is really when I'm going to see some increases in inflation. Now that all predicates on social distancing, not another resurgence of the protests. If we see a lot of that, I might have to push that V on the inflation out a little bit further. Now with the stock markets, there is a big differential in the stock markets and the computation of S&P valuations. Under new GAAP rules, there's certain types of incomes that are not counted in the valuation of the S&P. So again, you have to look at when these things change. So when somebody says, well, the PE ratio on the S&P 500 is this. Well, the question is, how are they valuing that? Did the rules to that valuation change? Yes, they changed. And so now when you actually look at how GAAP pulls certain incomes out into other incomes and non-accounted incomes, the S&P is actually pretty low on a consistent basis, which is going to bring me back to my opinion, which is the S&P 500 is grossly undervalued based upon these new valuations. And I'm making this estimate that into next year, we're going to see one of the best stock markets and investment markets we've ever seen. However, I do want to make a little comment here. When I did the webinar on the investments and the new paradigm shifts, I had a good question that came up because if you've listened to me for any time in the past, you know that I am a big proponent of ETFs and broad-based markets, meaning that when I compile a portfolio, we want that portfolio comprised of no less than at least 8 different markets. And that way we have negative correlation and we have the reduction or at least the balancing of the volatility. However, one of the good questions is when I talked about moving into paradigm shift types of sectors, I want to state real clearly, I am not a sector rotator. I do not pick sectors. But what a lot of people don't understand about the S&P 500 or really any of the indexes is that the indexes themselves don't just keep the same investments. They change out investments based upon market cap. Yahoo went in, Sears went out. Sears went out of business. JCPenney came out. GE came out. Sometime Boeing was going to come out. So even the broad-based indexes make changes at least once per year. So there is this misunderstanding that you can just buy a broad-based index and say to yourself, well, I'm just going to let this thing run on my own. I got 50% in the S&P 500, I got 50% in long-term bonds, or whatever it is. That's a two-part index allocation. I'm suggesting at least 8 different indexes, but the brunt of what I'm trying to say is you can't just pick indexes and just let them ride, because the indexes themselves will take things out. But when they take things out, they're taking them out because they dropped in value and they're not a component that meets the criteria of that index anymore. So when you look at an index and you say, what does brick and mortar retail look like? Well, Sears goes out of business, JCPenney's goes out of business. We all knew that this was happening. So if you know that, then you can focus down on certain sectors that you know are dying breeds, right? I mean, if you would have invested in CD-ROMs, right, then you knew that was dying with Blu-ray. Then you invested in Blu-ray. You should have known that was dying with live streaming, right? So you can predict in certain methodologies when certain things are going to happen. What is changed with the virus? We know that people are not all going to go back into office buildings, right? I mean, Google, Slack, Microsoft, Twitter, Square, they've all said we're talking about millions of workers, right? We're talking about all these different companies that are saying we're not going to send back our workers into the normal retail or commercial space. So we know that certain things are going to be pulled out of the broad-based indexes. What you can do is you can change that allocation in advance, because if you know that those things are just dying and they're going to be replaced. So what will the broad-based indexes replace some of those dying things with? They're going to replace them with the work-at-home stocks. They're going to replace them with data storage real estate. They're going to replace. So it's not that you're trying to market time or predict, but there are certain things you don't need a crystal ball to hit you right in the forehead to say, yeah, brick and mortar retail and commercial space is never going to be the way that it was, because now people have been accustomed to working at home. The new technologies have been applied. There's 51% of the workforce that in just a recent study that says they do not want to return to work, and they would consider looking for a different job if they were mandated to go back to work. That right there is a huge paradigm shift that you have to forward look into that. So again, this is not sector rotating. Sector rotating is saying, well, I think hard metals are going to go up for the next 3 months, so I'm going to throw it in there. And next week, I think that live streaming is going to go up, so I'm going to throw it there. But, live streaming is down, so I'm going to go throw it over there. No, these are major changes to the indexes that have long-term effects. So again, if the indexes change, you should be changing, but if you can forward look ahead, do it ahead of what the indexes are going to do. Let's take a look at the stock market index. Well, it had a pretty good week, right? So here we are, we're only down 3.9% for the year. And if you take a look right here, we got 3.9%. Let's take a look up here. 2018, we were down 4.38% for the full year. So it's interesting that everybody's on pins and needles, like, my gosh, the world's coming to an end. This is a lot of media generation, because when I look at the fundamentals, I'm not that worried about it. I'm kind of excited about it, because again, when you're using the techniques and the options that we're using, then you could actually take advantage of these different opportunities. So let's just jump back in. Hopefully you've had some previous experience of me walking you through what's called an economic map. And I've broken that down now into 3 phases. Phase 1, and we're just coming out of phase 1, and now we're going into phase 2. Phase 2, we have the vaccine and the election, and these are the things that we're watching on a very, very close basis. However, right within this zone here, we're also watching the protests, we're watching the reemployment, we're watching the occupancy of bed rates, and a lot of that is going to make a difference on what the stock market does. Now, originally, you heard me say that over here, where I estimated the tax increase happening in a big way. Well, again, the election is also going to make a difference as to what is going to happen on the tax front. What happens on the tax front will affect what happens on the stock market. So again, these are all very close things to be watching. So what are the actions that you can take right now? RMD payback. Now remember, if you didn't attend my recent webinar, it used to be that if you took your RMD between February 15th, February 15th and May 15th, you could pay it back. Remember, the IRS just changed that. So if you took your RMD all the way back to January 1st of 2020, jumped ahead there, 2020, you can now pay that back with no tax consequences. But you got to really question, is that a smart idea? Because if we're making these estimates that tax rates could go up to 70 to 80 to 90% like they were in the 1970s, do we really want to defer a whole bunch of money? We have to look at rebalancing. This is a great time to rebalance, especially if you're going to do paradigm shifts. Tax loss reharvest. Take advantage of those little sectors that have gone down. Strategic distributions. If you're going to need cash flow, where do you take it from? Do you really take it from the dividends when you could be reinvesting the dividends because the share price is low? Or do you alter your strategic distributions for cash flow if you're retired? And you have to look at the change in investment direction based upon the paradigm shift. These paradigm shifts happen every big cycle. They happened in the tech cycle crash of 99. They happened with 9/11. They happened in 2008, 2009 with the real estate. And here we go again. This is how you take advantage of the future, by just knowing what's going, not that you can know what's going to happen, but you can step back and recognize, hey, we don't have office buildings full, we don't have restaurants full anymore. Things have changed, right? We have refinance your home. Now is the time to do that. Do not wait, because when these foreclosures are going to hit the fan with this big bubble here in about a year, I don't know what refinancing is going to look like. I don't know how many banks are going to go out of business, how many places are going to be able to actually refinance you. Restructure your trust and your family protection plan based upon the Secure Act. Not just the Secure Act. I know I've been harping on that because that changed in January. and that really affects who inherits your IRA. But let me state something else. We learned so many things in this pandemic that we wouldn't have been able to even study in the 1929 crash, because back then we didn't depend upon notarization or digital footprints or any of these other things. But let me give you an example. We had experiences, and we actually read some of these cases where, let's say that you had a mother or father, and they're living in New York City and you're living on the West Coast, and they're in a nursing home, and they get sick, and you try to contact the nursing home. Well, during the pandemic, you couldn't even contact them, which meant that there was no way to actually get the digital access. So we had people that none of our clients had this, but we read about these cases where properties went into foreclosure, water bills didn't get paid, the air conditioners didn't get turned on, so there was mold in the house. And why? Because somebody that got sick in one area, and when they shut down travel, the kids were not able to actually access accounts, access online. So what we've done is we've remodeled our trusts, we've remodeled our systems, our processes, and this way, if the right program is put into place, even if you get sick, then somebody else can take over without having to have physical access or physical confirmation. So those are some changes. So it's not just the Secure Act, which is why you should restructure your trust and family protection plan. It's all these things that no one ever knew could ever happen. So we look for major Social Security changes and what you need to do to restructure income to reduce or eliminate new penalties. I'll show you, we're going to be doing a webinar on that. And then the election protection strategies. And here's the webinar. Listen, if you go right up here and you see this little thing up here, hhrdm.com, hhrdm.com, and you just come over here to the more, and you click on events, then you click on webinars, and you go right down to the bottom there where it says register now. And on July 7th, at 6:30 p.m. Pacific Standard Time, I'm going to be doing a webinar on the upcoming Social Security changes and what you need to do to make sure that you're protecting what you've already paid for. And if you haven't yet subscribed, what you can do is go right up here to the YouTube channel, and what you can do is just go into Google, and what I tell most people to do, the easiest way to find our channel is just type in H&H Retirement, and I'm trying to write this here on the screen, YouTube channel, and it should take you right to what you see here. And then you just hit this little red subscribe button here on the right hand side, and you'll be able to get onto our channel where all these broadcasts happen on a regular basis. Hey, if you've got a situation and you're not a client of ours already, because if you're a client of ours, we're already doing all these things for you. We're following these algorithms, we're making the changes, we're doing the calculations and the tests. But if you're joining the live cast today and you'd like us to review your current situation, we do give a 30-minute phone consult without charge, just to see if there's a match, if we can help you. And what you would do is give our office a call and schedule a time. It's 844-702-1040. Again, that is 844-702-1040. Or you can go right onto the YouTube page, which I just showed you. Look us up on Facebook, or just go to the events and you can subscribe to the next webinars. Hey, with that in mind, you guys have a really great holiday weekend. Enjoy yourself. Get out there in the sun. Stay safe. Let's improve this economy. And